Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month lead and tin.
LME 3-month lead. This market's decline over September and the main part of October occurred after prices failed to achieve the bullish potentials of the two ascending triangle patterns and the two reverse head and shoulders bottoms seen earlier this year. In mid-September, the move lower basically started that eventually led to a September to October based bear channel, currently 1945 to 2074. As prices dropped down through the 50% Fibonacci lines at 22.25, 21.39 and 21.34 plus for quite a while below all the moving averages. Prices fell down as far as the January 2020 high at 20.29, 2 weeks ago. However, at that low point, the market saw a combined daily key reversal up and bullish engulfing pattern that started to drive back up. 2 weeks ago, I said, and I quote, "The action since mid-September today could be a bear channel. However, it's early days on this idea of a bear channel, which is why I have not highlighted it. But it doesn't take away from the pattern being there." End of quote. As you can see, we have had this bear channel fully formed. I further added, and I quote, "Only if we see the market stabilize at this January 2020 high at 2039, as it did back in early July, only then can we see prices possibly using this bear channel to move or even vault into the next pattern." And that's the end of the quote. Prices have indeed stabilized there and ridden back up again to the top of the bear channel, and late last week up through it to test the slowly declining long moving average overhead, currently at 21.21. And also the 50% Fibonacci line of the March 2020 to March 22 move at 21.35, and even the very slowly rising medium moving average, currently 21.40, where they seem to have for now stalled. However, I draw your attention back to last Friday when the market breached the upper bear channel, and we've had consecutive closes up and outside this bear channel. This now gives me the opportunity for pointing out potential targets topside for a break of such a pattern. Thus, we have a primary target X in the 2185 area, with a secondary hard to reach target X1 in the 2270 area. Now, I've already mentioned some of the obstacles on the way on the upside, the long moving average, the 50% Fibonacci line, the medium moving average. Well, I'd also add the flatlining short medium moving average as well, currently at 21.58. I'm not necessarily that keen on the upside at the moment, but those are the ones that are out there. The one outstanding question left is whether this breach of the upper trend line, does it indicate a possible new pattern in the offing? I am, like last week, still not sure on this last point. And I am not sure as yet, if we do have another pattern, what this pattern could be. Last week I even took a look at the longer term charts to seek inspiration and found nothing there. As I said in finishing last week, and I quote again, I just suspect the upper bear channel line is just not that strong a resistance. This market requires some further pondering on my part. End of quote. LME 3-month tin. The most obvious feature had been the late October 2022 to mid-March 2023 bullish shift visual, which was highlighted, but on which I have now decided to reduce the emphasis. In mid-August, the market punched down through the lower time, as well as all the moving averages. Interestingly, these moving averages had slowed earlier attempts lower, such that we even seemed to form a possible halfway hesitation with the action from late July until the start of October. It even looked at the start of October that we might have a decent second leg to the halfway hesitation lower, but prices ran into two significant supports that stopped the decline. The first support is an obvious one. It is the series of congestion bands below, specifically between 23.850 to 24.155, and then between 22.895 to 23.55. I've spoken on these before, so they should be familiar. The second has been a newer, less obvious one, but one that needs to be considered, even if it's not a perfect example of one. It is the June to October potential head and shoulders pattern, with the neckline highlighted on my daily chart in bright red, currently at 23,280. As I've already said, this is by no means a great looking pattern, with the second shoulder having quite an extension on it, but it's still worth considering. These two supports caused a turnaround back up at the start of October. That further caused a cautious move higher, up through resistances from the 50% Fibonacci line in the October 2022 to February 23 move, which is up at 25,020. Then the 2013 high at 25,250, and finally stopping and turning lower at the declining short medium moving average overhead, currently 25,345. The decline from there over the last 2 and a bit weeks has also been cautiously, with the occasional foray down to the 24,500 zone, but always closing at or near the 50% Fibonacci line at 25,020. That was until, well, really yesterday and Friday, when we had for the first time 2 consecutive closes yesterday below the 25,020 zone, and this, I believe, has led to the rapid decline today. In a fairly free area of support, with the 25,020 area now out overhead resistance, and market moving down to the previously mentioned congestion between 23,850 to 24,155, and then between 22,895 to 23,555. I would add one perhaps controversial point, and that's to regard this market as still being caught, at least right now, between damaged but still working significant resistances overhead, as we know, especially the short medium moving average, and significant supports below that are currently being tested right now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.